You know, Jason, I think if people understood how close we cut it each and every week, they would be impressed that this podcast is only as scuffed as it is. I
Seriously.
applaud you for getting here on time. I believe you got a dual setup going right now. Phone for video, computer for your mic.
No. There's no computer usage. It's all on phone and just AirPods. So people are usually complaining about sound quality on here. So we're just keeping up with appearances. So when the audio version comes out, I will be on AirPods. So it'll be nice and tinny and nasally, and you'll have that deep baritone just popping on that Shure mic.
In an echoey room. We love it. Well, I was going to ask you to do the intro, but I'm going to go into it.
Before you
I'll
do, shout out to 96 Barrels of Beans. Says first time listening for the live Booty Crew. Normally listens at 2.5x speed. Can you imagine listening to me at 2.5x speed?
I would say listening to me at 2.5x speed is normal speed. You at 2.5 is like, I don't know. I got to imagine that's what being on crack would be like. Okay, well, let's dive in with that. This is the Pirates of Finance, the show that is in theory about markets, yelling about economics, sometimes about business, mostly about nothing, but certainly definitely not advice of any kind. Financial advice, tax advice, legal advice. Talk to a professional. Don't listen to two guys who can't even figure out audio equipment. With that, Jason, I feel like you were trolling me this week. You were on a little podcast called Excess Returns.
Here we go.
And fucking Ty Lopez over here says he reads 150 books a year.
Yep.
And I realized why in last week's episode when you said, hey, Corey, have you ever read this wonderful book called And a Bottle of Rum? And I said, well, yes, Jason, you recommended it to me. I have to really question whether reading 150 books a year is worthwhile if you clearly don't remember the books you read.
No, it's not. Well, second of all, by the way, I forgot to say why I'm on phone and AirPods is the power went out about 20 minutes before the show started. So hopefully I've got enough juice on my phone and my AirPods to make this shit work. But I think, thankfully, I can't listen to that podcast or I'll blow my brains out. But I'm pretty sure I said after there, but that number has come down in the last few years, especially due to podcasts, YouTube, etc. So a couple of things on that. One, ever since I was 13, 14 years old, I was 13 when I read The Fifth Profession, and that just developed my love for reading. But I've averaged about 100 books a year with a variance plus or minus about 50 books a year. And then when I was in my 30s, I actually was definitely reading at least 150 books a year. I was really crushing it, trying to figure out some certain things. And then now I'm lucky probably if I get in 50 books a year because of like podcasts, YouTube, work, everything is like, it makes it really difficult.
Buddy, I'm lucky if I get 5 books in a year at this point.
Well, that's how you remember them so well. But to your point about do you remember them is a couple of things on that. One, I only read books to try to find that one sentence that can, change my behavior or change my life. And I'm really just trying to like unlearn the stupid shit I've already learned. So I'm really just trying to find that one sentence. So I'm not trying to remember the whole book. And then two, I think reading's overrated. Like everybody always gets so excited when I say that, or people exalt reading. It's like, no, it's the same as watching a movie or, whatever your hobbies are or how you spend your free time. I don't think reading's that, particularly cool or interesting. It's just a habit.
I do find it interesting that reading always, to your point, gets this like exalted status of like,
Yeah.
oh, you read versus you watched a documentary, like somehow reading the same thing. Like if you read the transcript of a documentary, it's somehow better than watching a documentary. Everyone learns differently. There's people who prefer to read and there's people who prefer to listen or watch, whatever works for you. Okay. So that I had to point out
two things
because
it was before the DH in the question goes like, if you read 3 books a week, what else do you do? Where do you have the time? It's like, I don't have a life. That's the other thing. Like I don't have a wife or kids. I mean, I have a longtime girlfriend that we might as well be married. But like, I don't have any other hobbies. I don't have friends. I just like to work and read. Those are the things I like to do. So it's just that enormous amount of free time. And so that's why I think people kind of overrate it in general. I also have all my books around me because I knew you'd probably ask for receipts. So I have them. But the second thing I want to bring up that you pointed out is like how fascinating it is. Like this week, secret time, I haven't told you, but this week, this is why I might have very little to talk about, is I went off social media this week. So no Twitter, no Instagram, no YouTube, and no podcast this week. So that was like severe cold turkey for me. So I was reading more this week, obviously working more in general as always, but then I did listen to some books, audiobooks this week. And to your point is like, how isn't it interesting? Like, do you still hesitate? Like, you want to say, I was reading recently, even if you listen to audio or podcast, like you're saying, like, it feels like it's not as highbrow if you said I listened to instead of I read, even if it's the same book.
Yeah, I don't know. I would rather go for a run and listen to an audiobook than sit and read. Like, I think you get the same content. I don't know why the act of reading is somehow better than the act of listening. But I agree. I think the majority
you hesitate
of people
to say it though, don't you? Okay, so if you're running, and
but I wouldn't say I read the book. Well, actually, I would. If someone was like, "Hey, did you read that?" I'd be like, "I'm not explaining that I listened to it."
Exactly. But that's what I'm saying. It's like, why are we so fearful to say I listened to it?
Yeah, I don't know. All right, so that was a ridiculous statement by you, but not really the one that I thought was relevant to this podcast, because you said something else.
Oh, great.
Which I literally had to go back and rewind. And what you said was that your philosophy is to build businesses to sell them. And that could not be the more opposite than this might be the thing you and I, the wedge that finally drives us apart. Because my whole philosophy for life has always been thinking about, I am building my business to never sell it.
Yeah.
Now, we might probably just be saying the same thing in a weird way. We just think of it differently. Right? Like, because I could see, okay, building a business to sell means you keep immaculate books and records, right? Like, you just don't let that stuff get away from you. You do your annual financial audit. You keep all that stuff nice and tidy. You set up the systems in place to make it easy for someone else to step in and buy. Like, maybe that, I'm going to ask you for your explanation. But I always think of, like, when someone is building to sell, they're building quick and dirty and fast and trying to flip, versus building to sustain is all about that kind of stuff. Building to never sell, assuming you have to run the business forever, to me means you have to build it the right way. You can't sort of build it as a house of cards that you're trying to pass off to someone else. Again, I'll give you a chance here to recant what you said.
First of all, I'm not going to recant what I said. Second of all, this is just another great example of you front running me. You just like said everything I need to say anyway. And then the third piece was, I'm pretty sure I said exactly what you just said right after I said that, right? Like on the podcast. And so my point in general is actually you just made it. So unfortunately, we're not going to disagree, although I wish we'd disagree more, is what I said, I believe on the podcast is like, you build businesses to sell because that's the right way to build a business, but I'm never going to sell because I build businesses to last a lifetime. And my problem, I would flip around what you said, is like, most people that are building a lifestyle business their whole lifetime, they don't have the systems in place of a real business would. Like, so what I'm saying is like, I want to build a business that I hold for a lifetime, that I plan to hold for a lifetime, that is a passion project for me. But at the same time, you have to think about at an exit, how would a PE firm or somebody or an acquirer look at your business? And they're going to want to say, like you just said, all of those systems in place, the team in place. They don't want to see the key man risk, all of those things. Whereas I think a lot of people, and I've seen it, I'm sure you've seen it, friends, family, others, is like, or you can see it on anytime they have a business show on TV. Most of these people that run the business, they treat like the till like it's their personal money, and they do all the wrong things that you should do. So that's what I meant by that. And I'm pretty sure I hopefully caveated that after on that podcast, is that by building to sell, you put the right systems into place, but then you never sell. And that's just the right way to build a business.
But I would argue those people who build to sell, and this might just be my bias, but this like build to sell, build to flip mentality to me often means pursuing growth at the risk of blowing up the business versus running a business to run forever. I think you have to run more conservatively very often, right? It means using less leverage. It means potentially using a lot less VC growth capital, right? Because when you build to sell, often the sale is based upon a valuation multiple predicated on your growth rate. When you build a business to last forever, you might accept lower growth rates because you're reinvesting in all those sustainable systems. Versus the build to sell, it's like, not my problem. I just got to get the growth rate high enough to juice the valuation. Let someone else figure out fixing the house, you know, the foundation of the house after it's off my books. So maybe it's just my interpretation of the term, of the way like people think about build to sell versus build to last forever.
Yeah, I mean, it's semantics and nuance, but what you're describing, that person's an asshole. Like, who's gonna like I'm not gonna build a business that's a house of cards to get a high multiple and flip it. Like, that's just not. Even if I was building to sell quickly, I still wouldn't do that, because you and I both know the more robust you build the business, you could then force a higher multiple than that, because you can show that you have the systems in place. And anybody that's worth their salt that's looking at the business will see right through your charade of just trying to, you know, juice a high multiple with your house of cards.
Maybe. I think it depends on the environment, right? You get enough people starting to bid, you get a frenzied environment like we had in the last decade. I think that's where this sort of build to sell mentality came from.
I'll give you maybe another way of looking at another analogy is, you know, back in the day, I was a commercial real estate developer, right? And when I would build buildings, or, you know, build out, you know, even my own unit or apartment, I worked a lot with like interior designers and architects, pretty much did a lot of it myself. But the idea was, I was building, let's just say, an apartment to the customizations I would want, right? So every single thing in that apartment had to be the highest quality, because I assume from the philosophical perspective, I'm going to live there forever. But as a commercial real estate developer, if somebody comes with the right price, I'm selling. But every single time I could get a premium, because when you find the right buyers, they see the detail you put into that, and you could always garner a premium for that, and you never had to haggle about price. So it's another way of looking at the same thing.
All right, so I'm not in real estate, but I would counter with, let's consider all the residential real estate flippers who would buy a turd, polish it up.
Yeah, they're assholes.
And then flip it. Right, but that's like, so when you say build to sell, that's what I think. I think of that sort of behavior, which is I'm putting lipstick on a pig and just trying to get it out, flip it as quickly as possible, versus putting in the real work, which is only going to be appreciated by a few acquirers.
Yeah. And believe me, I've seen it a million times in real estate. And I think that it's not to throw shade on those people. I understand why they're doing it. And it's all about, it's a business, right? If I can cut corners on my counter cost, on the interior of my cabinets, all of those things, I can produce a higher multiple or a higher margin on my flip. And I understand that process. And then the people buying it don't tend to give a shit either. But I think it's just an entirely different mentality.
All right, so we got Jason Buck in his garage with his 150 books a year, standing in front of his Lambo, selling courses on how to build businesses to sell.
That's right.
I'm excited for this stage of your life.
Oh God, never. But didn't he, like, what's going on? Did you hate watch just as much stuff as I do sometimes? Do you know what's going on with Ty Lopez? I know, like, didn't he buy like Pier 1 Imports and all that stuff, but isn't his whole like thing like crashing down now or something?
Yeah, he bought Radio Shack and Pier 1 Imports, and then tried to turn Radio Shack into some sort of crypto project, and I'm pretty sure the debt caught up with him and the whole thing is falling apart. I'm trying to get out of hate watching, to be honest.
Yeah, that's what I was trying to do.
I don't have enough. Here's what I will say. What has become abundantly clear is that when you spend 5 hours every day feeding a baby, you don't have time to hate watch things.
Yeah.
It's just not, you don't have the time. So I'm trying to fill the little time I do have with less hate and more love, things I enjoy, or things that just absolutely need to be done. But so the hate watching has sort of exited my life. I also think a lot of the hate watch content disappeared. Like a lot of the 2020, 2021 financial media gurus have sort of disappeared off my YouTube algorithm. You know, the Kevin Paffraths and even the why am I blanking on his name? The one you and I typically say isn't all that bad.
Graham Stephan.
Even he's sort of disappeared.
Are you becoming one of those dads where you just have nursery rhymes? It's all just like super.
Well, unfortunately, yes.
friendly?
If you do one Google search for like what's the best, crib to buy your child, everything, your TikTok, your Instagram, your YouTube feed becomes just filled with dad stuff.
But this also answers your point earlier. What people asked in the comments is like, how do you read that many books? It's like, I don't have kids. My girlfriend works 24/7 too, so like I just have a lot of free time. Like we don't really do date nights or anything. I just have plenty of time to read and build my business.
How do you pick your books?
Oh, totally random. Like I just don't give a shit. I'm profligate. Like usually any book you read to me, like opens up like 10 more books to read when you're reading that book. So I never understood that when people are like, I don't know what to read next. And I'm like, I always have a stack that like, and like even right now I'm reading like 4 books at a time. So it's like that's usually unusual. What I've gotten a lot better about is not finishing books. Historically, I couldn't do that. Like I just had to finish it. Like I don't know, there's some sort of puritanical self-flagellation there. But at least now I'm getting better at like not finishing them and moving on to like what I find more interesting.
Do you ever? Yeah, I mean, how many do you finish them all? Like what percent of the way through do you get all the books?
Most of them I finished still. Like there's very few I quit.
Really?
Very few. Like I mean, maybe 1 out of 10 I'll get 50 pages in and just because I get so enthralled by another. It's not like necessarily quitting that one. I get so enthralled by other ones, and then it kind of lowers down the stack and I forget about it.
What do you do with the books when you're done with them? This is a big question. This one's tough because I like having physical books. I do realize it's probably a lot worse for the environment, but there's something like I really enjoy having a physical book. And then I'm always like, I like the book when I'm done. And then it sits on my shelf forever. So I've tried to get really good, other than reference books that I know I'll go back to. And I have some of those in the finance side. Like there's just some stuff I need to keep on the shelves for things I'll go back to. Other than that, I've been trying to like just to pass the book forward as much as I can.
Yeah, they pass the book forward, or God, there's so many things in there. I used to have a ridiculous bookshelf, and then every time I had to move, I had to box up all my books and everything, and that was just a nightmare. And then historically, then you could also take books to your local library, but now my local library is like, we don't want them. And so, yeah, they end up, most of mine end up at the recycling. And so, you know, to me, it's not only like, do I have to finish books? I have this weird, like you said, I prefer physical books too, because this is probably not the right term, but there's some sort of like kinesthetic awareness based on like the color, the design on the cover, the page style, like the paper feel. And like, I can, so sometimes I remember that was on the top right page of like this chapter. Like that's, I have a very like memory that's very aware of like the physical book. And so I have so much respect for physical books. I'm not somebody, I don't dog ear, I don't underline, I don't write notes in the margin. To me, it's almost like disrespectful to the book. I don't know why. And it shouldn't be that way. I should actually take notes in the book. But yeah, when I'm done, most of the time they're just getting recycled now. And like you said, there's been times where like, you know, especially moving around so much, I'm like, I really wish I had some of these like textbooks or reference books for like, say, options trading or something. But to me, I just give myself the budget of like, I can just liberally spend on books. So I don't mind just throwing them in the recycling. And if a few months later I had to pick up Nattenberg for the 15th time, like I end up just buying it again for the 15th time, then recycling it again for the 15th time.
Yeah.
But what that brings me back to is actually one of the books I was rereading in the last few weeks that I didn't even know he had a show coming out was Ramit Sethi's I Will Teach You to Be Rich. Have you ever read that?
No, I haven't. I mean, I've heard of it, but I haven't read it.
Terrible, terrible, terrible fucking title. But the whole book is about like just kind of like using technology to automate your finances, right? So as your like monthly gross comes in, you have all these separate accounts, it automatically cascades, and then whatever you're left over it's just your discretionary spending, your fund tokens, right? So great book in that sense. So I was kind of rereading that, but I didn't realize he's now making all the podcast circuits because he had a Netflix show that came out. But my point of bringing up Ramit is like he always starts with what's your rich life, and there's certain things like he has from where he grew up. And one of them is like he always buys appetizers now because when he was growing up, they couldn't really afford appetizers. Or if he has any flight over 4 hours, it's automatically business class or first class, right? If it's over 4 hours. So my point is, and I think he also has books just liberally spent on books. So that's one of my things is like I have, you know, coffee, sparkling water, and books. Those are the things I spend liberally on.
So I'm going to change the topic here. Talk a little bit about markets. I think it's about time. Third of the way into the show. Might as well finally talk about what this show's about a little bit. I'll give you 2 options. One, how did we go from the United States is about to default to no one's talking about CDS anymore? Or 2, is this the most hated bear market rally of all time?
I think they're related to each other, but let's start with the CDS side because you were texting me about this. What was my comment?
I think I don't remember what your comment was. So I think we touched on this last week a little bit, but CDS, I think it was 1 year CDS on U.S. sovereign debt spiked to like 130 basis points or something like that, way above where it's been in the last time we were like that. I think the 2011 downgrade. Everyone's going, oh my God, the probability of default is so high, especially when you consider the fact that when you price these things out with something like Bloomberg, it typically assumes a recovery rate, which might be appropriate for something like corporate bonds. Are you going to have a recovery rate if the U.S. defaults on its debt? Probably not, which means that, you know, a CDS of a certain level is implies an even higher probability of risk. I think this is one of those cases of, I'm just going to say it, macro tourism looking into trying to derive signal from an asset class that they don't trade. And when you don't trade it, you lose all context for what's actually happening in that exposure, right? This CDS generally, especially post 2008, are pretty illiquid, right? This is a market that can move a lot on a little bit of trading. And so trying to derive signal from that when you could just have, you know, a little bit of supply demand mismatch, I think can lead people to make incorrect conclusions. And I see this a lot. I want to get your thoughts on it about like the idea of trying to derive signal from the market if it's a market you don't trade.
Well, isn't that every pontificator, every newsletter writer, every global macro tourist, that's what they do, right? Drive signal from something they don't trade. You know, they're all dilettantes. You know, think they're polymathic dilettantes. But one of the things you pointed out that we were texting about is like that the kabuki theater, that political kabuki theater of a debt ceiling. Man, I'm glad you brought up this topic, so I'll get all the hate today, just for all of my opinions on this. Is like or lack of opinions, is like this just charade of the debt ceiling is like if you wanted to, you had to buy that CDS prior to all of this, right? Because like you said, it spiked so much, and you were asking about it. And what I texted you, what I asked my text was, I just said too late. Like if you're looking at the spike in CDS, it's like should I be buying, CDS on the US? Like too late. Second of all, it's like how are you going to get paid? What's the settlement in?
Right.
Right. If the US defaults, like the cascade of consequences from that, like where's your safe harbor in that scenario?
Well, and so to that point, this is, I think most people talking about this couldn't tell you what it settles in, but it doesn't settle in dollars.
It settles in euros, right?
For this exact, it settles in euros.
But what's happening to euros, the US defaults?
Right. So, but on that point, like you have this quanto risk, right? Like you have this cross currency risk that comes into play, which to your point is if the US default, what is happening to the euro at that point? That's going to affect the price of this derivative contract in a way that my guess is, again, I don't trade this. I'm aware of this stuff, but I would not, without talking to someone who trades this stuff all day, I would never try to derive any meaning from these markets.
No, and the other thing that, going back to your actual original question, is like this is similar to like meme stocks when they were pumping and the YOLO trades, but more importantly, like what both of us trade with, put options and VIX contracts is like volatility spikes and mean reverts, or volatility can cluster if we know our Mandelbrot, but you don't know a priori. And most of the time after it spikes, it just crushes back so hard again, like you're saying what's going on right now with CDS. So it's like, at what point do you buy in? This is like catching a falling knife. And unless you're an expert on this, I would also maybe look for more tangential trades, maybe in euro dollar or euros, if that's what you want to play. But like the idea of buying CDS on the US government is kind of an anathema to all trades. And like, who is an expert on CDS on the US government?
I don't know who would be, because it's a market that trades, right? But you've never had a default event. No, like how do you really think about pricing something that's never happened before?
And then the other thing is like, it's just, what do you do? Like, and who's taking the other side of the contract? It might settle in euros. Like, I just think of like 2008, how many people I know that made money off of shorting the markets in 2008 via put options, but then had counterparty risk, and it took them 18 months of lawyers and courts to get the money, clawed back, or at least a certain percentage of those dollars clawed back. They didn't even get the full notional value. And as we saw, everybody's seen the Big Short or Reddit. It's a similar scenario. It's like, what's your counterparty risk? What do you get paid in? What happens in that kind of scenario? But to me, it's semi-analogous to when you had choose your own adventure. Is this the most hated kind of bear market rally? And the question is it even in your question, you insinuated bear market rally, or is that's assuming that it's going back down again, or is this the bull market? Like,
it might go back to the most hated bull market, which I think, man, that was a phrase, most hated bull market, that was used heavily in the early 2010s, right? Because post 2008, everyone kept saying this is, it's coming around again. 2010, 2011, 2012, it was constant. Oh, Europe's not out of it. Oh, US debt downgrade. Oh, we've got problems in Greece. EU's falling apart. And the market just kept marching up. It had some of these hiccups, right? August 2011 had some hiccups. I think it was like spring 2010 had some hiccups, but the market just kept grinding up that wall of worry, and people hated it. And so you got this most hated bull market ever. I think right now, and I mentioned this the other day, like my timeline on Twitter, every macro person is bearish.
Yeah, because you sound smart. Like that's the thing. To be skeptical, people think is a proxy for intelligence, and so that's why you try to call 60 of the last two bear markets, and then you see I told you so, and you always look more intelligent if you're skeptical versus optimistic, right? The optimist is kind of the dunce in the corner. So that's why you're typically going to see that, especially on FinTwit. But part of what you're saying is like, it's this sentiment trading, right? And as we kind of always make fun of, it's like, when people bring up behavioral finance, it's like, yeah, everything's behavioral, therefore there's nothing behavioral. So like, what can you do about it? Same thing with sentiment. Is everybody's going, here's where the sentiment is on this trade, but that doesn't help me trade or make money or not lose money. Like, let's think about like even like Jared Dillian, right? On his newsletter, he's a sentiment trader. So he's one of the ones that's been, talking about whether it's the CDS or you're saying this bear market rally or dead cat bounce, or is this the bull market? The other one he's bringing up is real estate, right? He thinks we're at like peak real estate because like Vox and all these other people are saying like how commercial real estate is going to get crushed, how the real estate market's done, these higher rates for longer, all this stuff. And his sentiment is saying like he thinks it's over because it's peak sentiment. Now, do any of us know that for certain? No. How do you trade off that? I have no idea. But he is giving anecdotes, but also, the plural of anecdote is not data. But he's talking about like sections of New Jersey where prices on housing are going higher and higher. And I've noticed, at least here around this like Philly area, they're listing for higher and higher. I haven't seen really the sales data, but like, that's another thing that maybe that most hated bull market right now in stocks is like, do we still have that base for housing of millennials and Gen Z that want to, have house formation and we're still undersupplied? I don't have any idea. Like you and I are like, some point the housing market's got to crack, but like as we talked about when you and I were walking around Florida, is like, I don't know if anybody can predict that. Crazy shit happens.
Yeah, we say at some point it has to crack. I guess, does it, right? Does it have to crack? I don't know. I feel like the narrative cycle of, and again, I don't want to just hate on macro people because it's not just macro people. There's a whole swath of people who are bearish right now. But I feel like the narrative cycle is always the same, which is in the early part of the bear market, those who call it correct pound their chest about their performance.
Yeah.
And then once the market starts going against them, they start to say, well, it's all about managing risk. If you don't manage your risk, you're going to blow yourself up. And then they go quiet. And then eventually they go, if the market becomes a bull market, they go, oh no, I flipped. I was bullish. All right. And it becomes this like, I've noticed this trend of like how the speech changes, how the comms change throughout the process moving against them.
It's like fishing or golf stories, man. It's a narrative fallacy in hindsight. And, everybody thinks it's amazing how they can block the bad and harness the good. But another example of it is, Hugh Hendry, love him or hate him. I think it was 2015, where he made his bones for over a decade as a negatively correlated but positive carry fund. Like he did an amazing job over like a 10, 15-year period. And then in 2015, he wrote like a letter to investors that like said something of the effect of like, would it surprise you if I was bullish on everything? And like he was like, I don't see anything really. I shouldn't be short anything. I should actually be long GDP in this scenario. And basically, all his clients said, we don't give a shit, and just redeemed. And so it's hard. Like if whether you made your bones on a newsletter or hedge fund as being negatively correlated a bearish style or a bull style, it's really hard for people to see the opposite side.
I do get that though. Like if your mandate is not to be a go anywhere, do anything, and you're getting institutional allocations for a very particular mandate, and they're using you in that allocation, and you say, I'm going to have suddenly massive style drift that puts you offside of certain beta targets, I can understand that redemption. So there's the narrative of the story, which is Hugh went from bearish to bullish. Hugh ended up being proven right, and everyone redeemed and, oh, aren't they dumb? When in reality, it might be much more complicated. Just the way money is managed in this industry. He was running a hedge fund. He had institutional allocators. If I am allocating to someone and they have a dramatic change in style that no longer fits in the bucket in which I have them, right? That he might have been part of like a dedicated hedge sleeve. If he goes long GDP assets, okay, I got to sell him and find a new manager for that sleeve. Maybe I'll buy him back in a long GDP sleeve, but he's got no track record there. So why am I buying him versus some other proven track record manager? So I do think like the conversation there is a lot more complicated than sort of the headline narrative of like, haha, dumb allocators.
No, no, absolutely. Like you and I have talked about this many times before, and I've had to explain to mutual friends of ours is, maybe some of the alpha that retail or DIY traders can have is they can go anywhere, do anything, right, and be an absolute return. Where to your point is, there's really a lot of nuance in the institutional allocation of the space. Like everybody likes to, like you said, shit on hedge funds, like, oh, they missed the bull or the bear market. It's like, well, what is their mandate, right? And they have to stick to their knitting because, as you're referencing, all of these capital allocators at the institutional level that are looking for hedge funds, they had very, very niche, narrow strategies. And the capital allocator likes to choose their own adventure and put those together in their own pie chart. And so you can't have those managers going anywhere and do anything. So they're highly constrained in those golden handcuffs of sticking to their knitting. And that's a great point you made with Hugh, is like technically those institutional allocators had to pull, right? Like that's not what they had them in the books for. Now they could have figured out, rework their book and maybe place them in another, return driver asset class bucket. But that's much harder to do for the capital allocators, and they don't do that.
But let's say, Jason, you ran a fund of hedge funds and you had a very talented manager who did one thing really well. Let's say it was a tail risk manager. Yeah. And all of a sudden they said, I don't think tail risks have to be managed for the next decade. I'm just going to take the whole fund and go long S&P futures. What are you doing with that manager?
There's two things in that. One is, as you know, I hate.
First of all, I don't even think they could. My guess is they couldn't even do that by mandate definition, but assume they could.
Well, two things. One is, I hate when vol relative value or options relative value managers are like global macro pundits, because I'm like, just stick to your knitting. Like the global macro environment doesn't matter to what you do. Please do not be a global macro guru. That drives me crazy. Second of all, I will be a bit disingenuous. Is like, it's a conversation, right? If that manager has that, and I said, okay, maybe we can put you in a different sleeve because of the way we build our portfolios with offense and defense. It's possible to have that conversation. Not likely, right? Because you wanted to stick to their knitting and you had a very, specific sleeve for them. But more importantly, I may be able to have that conversation with them, but all of their other institutional allocators are going to cut them. So they're dead anyway.
So
they're redeemed out of existence, like Hugh Hendry was.
Let me push back something you just said, which is just to play devil's advocate. You said you don't like your relative value vol guys to be macro people. And when you're talking about relative value, right? Long one thing, short another, especially in the land of vol, where macroeconomic events can have an outsized impact on certain parts of the volatility surface. Don't you think having a view there is important for forecasting realized versus implied, or one part of the surface versus the other? Like, there's going to be an announcement. It's a Fed day. Is vol on that day priced too expensive versus the one day after?
Yes and no. Like, you have to have awareness of events that could be catalyst, right? But most likely you're going to see it in the vol surfaces, and you're just looking for these kinks in the vol surfaces for them to come back into line. But like, you're right, you have to have a general idea what's going on in the macro environment, and you need to know, like, if an election's coming up, et cetera. I think even our buddy Ben Eifert used to talk about when Kuroda started implementing the 3 arrows policy, people didn't realize the way that the options were tilting before then, and they were about to flip. And so like people missed out on a lot of that, not paying attention to kind of the global macro. But I think there's a difference between pay attention to global macro. It's like when you're looking at any of your individual stocks and the earnings are coming up, like you have to know when those dates are, or options, you have to know when expirations are. That's one thing to know the landscape, but to pontificate and have a directional view on the global macro landscape is an entirely different story.
Right. Okay, I follow.
Well, if you disagree with that, that's fine.
No, I think you and I would argue it's very hard to have a view on the macro landscape. I do think there are different factors you can look at that are potentially helpful in forecasting realized versus implied. There are plenty of hedge funds that do exactly that. Not necessarily macro, discretionary macro views in flavor, though.
Did you speaking of this podcast, the Excess Returns podcast, did you ever re-listen to yours when you were on?
No, I don't listen to my own
I
podcast. Are
didn't
you
think so.
insane?
Exactly. You know, it creeped me out when I called you the other day and you were listening to mine. I'd hear my own voice coming through the AirPods.
I had to turn yours up.
Two things. Well, let me pause on that for put a pin in that. Like, man, how much do I wish we could have had some of our private conversations on the podcast this week? Not to like just like really tease everybody, but man, there's no way we could have had those conversations on a public forum. But man, those are some good ones this week. But going back to like, because I listened to yours, Excess Returns, you listened to mine. But what I would guess, we should have a third party like Tyler go back and watch them and just see the overlap, because like I told them before I came on, I watched yours and I was like, I'm just going to say pretty much the exact same thing Corey just said.
Yeah, I got lucky. I went before you, so I just front ran you. I knew exactly what you were going to say. And I said, even if I don't believe this, I just want to take the opportunity away from Jason.
You know, what we did, once again, we're morons, right? Because like if we were smart and we were trying to create a good show or podcast, we would use like those old like political roundtable shows that were on like the weekend mornings, where you get like a Democrat and a Republican that are just both really vociferous and like to get in fights, and then like that creates great television. It's like we agree entirely too much.
Yeah, we need like a third leg of this stool. Well, it can't be a third person because then we just gang up on them. But we need like two people who are deep discretionary global macro people.
What I feel like all I'd be doing is like objection, speculation. Objection,
which
Your
is
Honor.
by the way, speculation is kind of the name of the game when it comes to markets.
Right. But there's like nothing to back that up. It's just like they're pulling it out of their ass every time.
Yeah, well, some of them do it successfully for at least a while.
Have you seen any of these anecdotes in the housing market, or what do you think?
What do I think of the housing market? I think my anecdote is my wife wants to buy a house.
Exactly.
And she doesn't care what the price is. So when I say things seem expensive to me, her answer is, well, it sounds like you should work harder. I mean, like you know who New River Invests on Twitter. I think he is one of the best second, if not third level thinkers I've ever met. Guillermo has an unbelievable gift to think things through in a second and third order impact way. In fact, I think so much so he can't think linearly. Like I'm surprised he can even put pants on in the morning. I think it's just too simple. And even he would say, for all the sort of things you can think about the housing market, it doesn't matter. It's such a behaviorally driven, when you do it, you're not making a financial decision. It's a totally irrational market. And so it's just not going to behave in line with rational expectations. Yeah.
Well, especially if you have boomers that are sitting on a ton of cash, or all these portfolios that can just buy a house as cash. They're not really paying attention to rates either anyway. So, and there's like, I deserve this. I've worked my whole life for this. Like, I don't care.
Speaking of boomers sitting on cash, so they're around here, actually more towards Sarasota. There's an area that's like a 50 square foot mile, just cookie cutter development. Basically these it's called Lakewood Ranch. Yeah, it's called Lakewood Ranch, and basically the way it works is like you get these 50 square miles that have been totally hand curated. All these fake lakes and rivers, and then developers bid on certain areas, and then they'll build the same 4 or 5 style model homes. And it's nowhere near the water. The amenities in certain parts are nice, like you have clubhouses and stuff. And one of the properties there just sold for $7.5 million. And these are not like, that's not like a custom, you've got a beautiful house. This is like, I'm just going to sound like an asshole. These are kind of like piece of shit, cookie cutter, everything looks the same, Stepford Wives, no, character homes. And they're going, and the other part that blows me away is there's more development coming. So if you buy a house, if the list was 1.25, now it's like 1.5, 1.75 in the last year. If you buy for 1.75, I don't know how you're ever going to retain any value, Because if someone goes to buy a new house, there's always new houses, right? So why are they going to buy your old house? Your old house is not going to appreciate when the new houses are coming on to the market at 1.75. Your old house almost by definition has to depreciate. And yet that shit's not happening because there's so much demand. They can't make the houses fast enough for people to move into this area. I don't get it at all. It's blowing my mind every time I look at that. And I'm like, clearly I'm the idiot because I should have bought at 1.25 and just flipped the property. But there's just such irrational demand for housing right now, particularly around me in Florida.
I wanted to pause for a beat so Tyler could clip that because you just perfectly described the housing markets in Florida and Texas. Like when you don't have a state income tax and it's all driven by real estate tax, all the incentives are to just keep churning and burning more properties, especially when you have more land, and just go out farther and farther or deeper and deeper into the swamps. And essentially that's what you do, right? And then nobody wants like a 5-year-old house because they want the new, but then it just keeps churning and churning and churning until it all collapses. I mean, that's quite literally the history of Florida real estate. Speaking of books, like you read Bubble in the Sun, I think I sent it to you. Like that's the example there. And I think we're starting to see that more and more in Texas. And especially because in 2008, Texas property didn't take quite a dip that the rest of the country did in 2007, 2008. But that's because it was coming from a low base. And now people are using that to justify why it's not going to have a dip in Texas when it's become a completely different market. And I think like when you talk to Dallas developers, it's like we're almost out to the Oklahoma border on building these cookie cutter subdivisions. So, I mean, you kind of nailed it on that. But the other related to that, going back to roommate safety, like you were saying about behaviorally, about dealing with your significant other is, you know, Ramit talks about like for 20-year-old guys or mid-20s or guys or girls, it's like, you know, you want to, one of your little partial savings accounts that you have is starting to save up for like a engagement and wedding ring and for eventual house. And they go, yeah, but I'm never getting married, bro. I'm never buying a house, bro. And he's like, yeah, you will. So you might as well start saving now, right? Because what you're technically dealing with. But the other one that hopefully, I think Ramit said he's going to really pound on the show is like he's always been a huge advocate of renting versus buying if the numbers add up, because he's always lived in like New York or San Francisco. And if you and I have talked about it a million times, like if you live in California, you're much better off renting than you are buying. And then especially if you're with the caveat, if you can be disciplined of using that savings to invest in other things as well, like there's other caveats to that. But I think it's really interesting that, and then I wonder the other day, like we always think as Americans, is this a cultural thing? Is like, we go, well, if a neighborhood has more renters than buyers, then people aren't going to take care of their property. So it's going to go downhill. Whereas like in Germany, the majority of people are renters and they have some pride of ownership. So is that a cultural thing that we can eventually change?
Maybe we're just assholes in the way we rent. I don't know.
Like
maybe
culturally,
yeah, we just don't care. Maybe that's true. Maybe we just care less about the property that we rent. For me, the hardest part has always been, and I was a homeowner from 2010 through 2019 or 2011 through 2019, and I've been a renter ever since. The hardest part for me is having such a huge amount of net worth tied up in an absolutely idiosyncratic investment. Like if I said to you, Jason, I want you to take out $2 million of debt to buy Coca-Cola stock, knowing that it will never get called on you, right? So you don't have like the path dependency risk of Coca-Cola losing 50%. Does that sound like a good idea?
Yes.
Okay. Well,
no, we think differently, but no. So like, no, you make a perfect example. We love real estate because it's the leverage, right? But I was thinking, it made me think about when we were talking about books, right? Like we don't want to say we listened to the book. We say I was reading the book because it sounds better, right? But like you just said, it's like you're looking at like that nominal or notional value of that house, and you're like, I don't want to take out millions of dollars in debt for like a small like or starter home or whatever. But I really wonder, and I think we've talked about this before on the show way back, is like, are we looking at it the wrong way? I think everybody just looks at like a mortgage payment as a rental payment now. And younger people can just block out the actual total cost of the house because it's essentially irrelevant.
Yes, that is absolutely happening where people go, I could pay $4,000 a month for a mortgage or $3,000 a month for rent. Like I'll pay the extra $1,000 and buy and earn equity in it. And it's like, well, Like the marginal amount early on that's going into equity versus paying down the huge amount of interest you have to pay. Like you might want to think through that. And by the way, you're not taking into account what else you could be doing with any sort of like other investments you're making.
Yeah, just as an example for people, on a 30-year fix, you're paying interest only for the first 7 to 8 years before you're even touching principal, and the average American lives in a home for 4 to 5 years. So, like you said,
so
though,
let me play devil's advocate now. Let me play devil's advocate because in my podcast episode on excess returns, I talked about thinking about human capital versus investment capital, something we've touched on a number of times, and the argument that you should, as a young investor, actually potentially take on a huge amount of leverage because your human capital looks like a long-term corporate bond for most people who are white-collar workers, and you don't have enough investments to balance it. And so you need to take an abundance of risk to be risk balanced. Why not take a huge amount of debt out, which is arguably immunized by your salary, to make a massive levered purchase of a risk asset? It's probably, from a path dependency perspective, far, far, far safer than levering up equities. Yes, it's idiosyncratic, but my guess is if I could lever up some properties in my early 20s, or at least one property that I would go, maybe it won't keep up with the market, but the total levered exposure I'm getting without the path dependency risk of going fucking balls long S&P futures might be worth it, right? Go buy some property in Brooklyn or the south end of Boston. Like those properties are not going to be cratering most likely.
Yeah, I remember you saying this on your excess returns, and I have a bone to pick. Is that one of the colloquialisms you hate?
I'm okay. I don't even know what that one means. Okay. So
I don't know either. But before we get to that, by the way, Bacon Mean said, I don't listen to Pirates of Finance. I read Pirates of Finance, which is perfect. But speaking of which, it's also that time for the Pirates Pinky Promise. Corey and I don't do this show for free. What we require from you, it's a little tit for tat, if you will. We need you to smash that subscribe button. Most of you that listen or watch the show aren't subscribed, and that's all we're asking for a return. The power's out here. I'm on a phone, AirPods. We're doing everything we can to try to do this every week. I was going to say consistently, but we're not consistent, and we do our best. I'll put it that way. But the only thing we're asking in reciprocity is for you to smash that like button. It's our Pirates Pinky Promise with you. But going back to Corey's,
I just want to say we received a great picture, by the way, this week from two listeners.
Yeah, shout out
giving
to
each other the Pirate Pinky
Dennis
Promise.
Yeah, I wish we could. Can we put that on screen? No, we don't have. We didn't put it up with Tyler. But
I'm not sure we have their permission to put such an embarrassing photo. Two grown men pinky promising
in a diner. It was awesome. It made my day though. That was awesome. Thanks, Dennis and Jason. So the bone to pick I have with you is like, I actually think, I don't disagree with what you're saying, is like, if you're willing to leverage up a house, why not leverage up like S&P or whatever you want to do, right? Like, to me, those are fairly analogous. My bone to pick with you is off the concept of ergodicity. The idea that you can go highly levered when you're young is based on the concept that you're going to live to like 82 and you have all this time to make up for it. And I just don't think that's an appropriate way to look at it.
Okay, but again, to go back to what I just said, this is where housing may make a lot of sense, because when you lever up the S&P, leverage introduces a path dependency risk, right? I'm 10 times levered. If I have a 10% drawdown, I blow up.
Yeah.
If I'm 10 times levered in housing, there's no path dependency risk there anymore. Now I could have the drawdown or and just say, you know what, there's such a big drawdown, I'm going to walk away from my mortgage and declare bankruptcy. But there's none of the path dependency risk anymore, so long as you can continue to afford the mortgage.
Right.
So from that perspective, so what I'm saying is, like, let's say you're 20 and you buy into this idea that you really should be highly levered on the investment side. Like, isn't housing potentially the way to go? Should you not maybe buy 3, if you can get the mortgages, right? 3 medium size houses, max leverage, as much as you can, diversify. And that's really what you should do, because that's the safest way to get max leverage versus, going levered up S&P futures.
I think you
and the tax efficiency.
Yeah, I think you just described the entire wealth balance sheet of the boomers. right? They were the first generation to figure that out. And no, like you're not wrong. That's what I'm saying. The whole point though is like the caveat is if you can afford all those mortgage payments. Like what happens if you lose your job and all those sorts of things. But like you're right, there's very few things like if you could leverage up PE and never take those markdowns, right, and never get capital calls, then like yeah, you could do that too. So
like what with the perfect benefit of hindsight, if you go back to your early 20s and like change the investments you made, what would you do differently?
two things. One, I had, I would have, as a commercial real estate developer that blew up in 2007, 2008, I probably would have tried even harder to work with my banks, even though I was too small of a fry for my banks to really work with me. I didn't quite have that leverage that like a Trump would to just say, your problem, not mine. To try to, like you said, to keep those. But also I was young, right? I was 27 years old. I thought that was over. I thought that whole housing run was done. So it's easy to say in hindsight. The other one though, to your point, was I was actually talking to somebody yesterday that made me think I was so dumb. If we were smarter, I would have gone back to when I was 25, which is almost like 2 decades ago, and I would have gotten into PE because those guys have just crushed the last 2 decades. And as you can see around the world now, they're the ones that are able to buy sports teams, invest in like large brands. Like, man, that's where I feel like we've been in the wrong business. It's like if I had a Wayback Machine, I would definitely be in PE and just levering up those private companies for the last 20 years.
Speaking of sports teams, I'll get to what I would do. But speaking of sports teams, McElhenney and Ryan Reynolds getting their team Wrexham up a league. They finally did it.
League. Yeah, they're finally in the full professional football league. They're in the 4th division now, so they're out of semi-pro into full-on professional. So
as the guy who knows this stuff, let me ask you a question.
Yeah.
My understanding is like the money share goes up, but obviously I would expect player salary expectations also go up. Right. Yeah. So like where's like a break-even win like from an owner's perspective, is your team now more valuable or your liabilities just going up?
Both. So the way to think about it is, I'll say it in kind of reverse order. So the Premier League's the top, right? The 2nd division is actually called the Championship. So what the Championship is known for is if you can advance from the Championship into the Premier League, if you can get that promotion, that's at least $150 million a year windfall. And actually, it's probably more than that now from the TV rights and everything, right? So it's one of the biggest lottery tickets in sports. So what's happened at the Championship level, though, it's a graveyard of billionaires overspending trying to get into the Premiership, right? And then let's say you get in there, you make that $150 million windfall, but then you're at the bottom of the table, you get relegated back to the Championship next year. Granted, they've tried to create some smoothing out, like kind of parachute payments for that, but this is why the Championship has just been the graveyard of people overspending trying to get in the Premiership. So then you just take that down a few levels. They're going from basically the 5th division into the 4th division. But to your point, and I've been texting you about, is like they were actually paying 2nd and 3rd division wages in the 5th division to get into the 4th division. So like you're saying, their liability and their weight, they're buying their way up, which people have done time and time again. But now to go from the 4th to the 3rd, you're going to have to buy your way up again. And so like you're right, your liabilities are raising, but the game everybody's playing, trying to get all the way to the Premiership, is yes, those player wages are out of control and they're getting to be huge liabilities. But the willingness of the buyers to spend to buy these teams that's the resale value is much greater than those liabilities of the wage bill.
Yeah. All right. So to go back to the question, what would I do? I said I was a homeowner. With the pure benefit of hindsight, I just would have had way more leverage on my home.
Yeah.
I did very well. I bought in 2011, and in Boston, that like perfectly timed the bottom. Not that I'm a genius. I just happened to move there, and I was looking to buy a house, and then sold in 2019, which at the time, once 2020 came around, I was like, I am a genius again. It was not a genius. Turns out things went way better. But I just didn't have nearly enough leverage. And that was largely driven by the fact that I had this business that I had started that while I had cash flow, I was still just very much in the entrepreneurial mindset. I didn't want to take risk in where I lived. Like I wanted this idea of if everything goes belly up, I still am safe to live where I'm living. That was sort of like my safety net. And so I just didn't want to carry a ton of debt. I've historically been very debt and leverage averse. And it wasn't until the last 2 or 3, probably 3 or 4 years ago that I really changed my mind on that and went, oh, wait, leverage is actually really useful for a variety of reasons. And I should be thinking through the best way to carry leverage in my life.
Yeah, yes and no. As you know, like you're much more circumspect about this and much more conservative than I am, and I have the scars to prove it. But at the same time, like you're saying, like this is what I referenced Trump earlier, and a lot of people learned is like it's not just leveraging up like your personal house. It's like no, like commercial real estate, et cetera. Like if you can leverage up hundreds of millions or billions of dollars with the bank has a problem. You don't have a problem, right? And they're much
Right.
more willing to work with you. And like I think it was even in I was rereading The Big Rich, and it was like some of the like one of the guys in there, I think it was Mike Murchison, said like no, you actually don't want to be able to you don't want to be able to repay because then they can put the screws to you. But if you take out more leverage than you can repay, then the bank has to work with you. So I think that's what people are doing is leverage on leverage. And then to the point though that you're making though, it has to have great timing though too. You have to be lucky on the timing aspects, right? So anybody like you said, if you bought super leveraged housing 2010, 2011, like you did, you had a 10-year run, like or a 9-year run where like you could absolutely crushed it. Even then holding through COVID, you'd add even more years. So you just don't know if it's going to line up with your timing. And it's always fascinating to me is like, if you look at almost like the majority of billionaires now, if you go back and read Predator's Ball, they were all taking milk and money, right? So these people were doing leverage buyouts. So to your point, they were leveraging to the hilt to build these, multi-billion-dollar conglomerates. And they all just got really auspicious on that timing. But that's like almost, it's shocking how many of those billionaires were taking milk and money in like junk bonds back then.
What do you think would happen if you got rid of the 30-year fixed rate mortgage in the US and went to like 7-year floating
Yeah, like
rate?
most other countries. Yeah, most other countries. Yeah, it's like you don't get these crazy prices that we get. Like I remember like when I was living in Brazil, I was looking at the Sao Paulo skyline. It was just shocking to me that like the longest mortgages were like 2 to 3 years and you had to put 50% down. They're like, you Americans are so rich. And I'm like, no, we have 30-year fixed mortgages.
But let
with no recourse.
me push you on that. What are the second order effects? Right? Like if all of a sudden we have to put way more net worth down and pay it off a lot faster. So maybe real estate prices have to come down because we can apply less leverage. But what does that mean we then can't invest in? Like how does that impact? Yeah, I mean like so if all of a sudden I have to put way more cash down on my home, either the housing prices have to come down or if they don't come down sufficiently, I can't put as much money into the equity markets. Or like how does it impact what are the second order impacts in the economy, do you think?
Well, yeah,
like in other words, is the rest of our economy benefit from the fact that we allow ourselves to have these crazy 30-year fixed mortgages?
Yes, because of like you're saying, the classic wealth effect, but also in the sense that leverage cuts both ways. And most people have just had the upmarket and leverage. And it sounds like you're coming around to my idea that we shouldn't have mortgages. Just saying. But also it was
Can you imagine if like suddenly you woke up and it was like there's no more mortgages? Like what would happen to housing prices?
By the way, that like as much as I love to like just really poke the bear and really troll our friends, is like I was talking to some friends that fancy themselves as global macro guys and everything, and I just said, what would happen if the U.S. went full debt jubilee? We'd probably have another 100 years of U.S. hegemony, and their minds just like exploded. Like nobody like wants to think about that kind of stuff. But like you said, I think it's interesting. I don't know why we have mortgages, but also going back to what would we do? Is I was like I said rereading the Big Rich book about the Texas oil money in the Big Four. It was fascinating is how many banks were lending to them to build their oil companies. That would never ever happen now. Like because we want these riskless things like lending to like mortgages and housing. Like we don't actually lend to entrepreneurs that are trying to build businesses anymore. And that's what I would hope for is like stop lending to mortgages that just jack up housing prices and hopefully people get a wealth effect because they're leveraged long, where we could be, using banks to create loans for entrepreneurial endeavors that are actually improving society and the economy.
Well, maybe that's what the PPP loan will be for.
The Pirates Pinky Promise loan.
The Pirate Pinky Promise. Okay, with that, let's end the show, Jason, with that bombshell. I want to thank everyone for tuning in to yet another Friday episode of Pirates of Finance. For those of you who joined us first time live, hope you enjoyed the comments section. I can't read it live because it just makes me laugh too much. I want to thank Jason, who scrambled last minute to make this work despite the power outage. Apologize for the average audio.
Audio.
I don't want to say poor audio. Average.
We're gonna see. We'll see how bad it is in the hate comments. On
Yeah,
the
we'll see.
audio
Well, you
later.
let us know how bad it is. Once again, go ahead, smash that like button, smash the subscribe button, leave a hateful comment, pump the algorithm. We appreciate it. We appreciate you. Have yourselves a wonderful weekend. Tyler, take us out.